What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Annie and Ben with you this week as we unpack the big news of the week. Charlie is taking a well-earned break. I think he's up in Queensland, isn't he, Ben?
Yeah, in the Whit Sundays, I think.
Whit Sundays, living it up in the Whit Sundays. Although I have seen him on LinkedIn, so he's obviously still making sure we're writing the news while he's away. Don't worry, Charlie, we've got you. And what a lot of news we've had this week, Ben. Lots going on, heaps to talk about.
Yeah, it's been a massive week, really, and I guess it always is, particularly when you're a person down as well. That always seems to be the busiest week.
It feels a lot busier, yeah. But we had the MFAA conference, the national conference this week, which I saw lots of people at. Really good fun to be down in Melbourne for the national conference and awards that the Mortgage and Finance Association of Australia put on. And I was moderating actually a panel this year on the future of broking, which we'll talk about in a bit. But some of the speakers I thought were so fascinating. I mean, a lot of the theme for this year's event was called Built on Trust, Ready for Tomorrow, really looking at the future vision and what does broking look like moving forward and what are the big challenges and opportunities that are currently in market. And, you know, hearing for some heavy hitters as well. We heard from the Assistant Treasurer, we heard from ASIC. And I think from a sort of news reporting angle, those are probably the two speakers that really stood out for me, particularly the ASIC Commissioner, Alan Kirkland, who was chatting about what ASIC's been doing for the best interest duty review. Because as many people listening to this may know, the Financial Services Regulator has been doing a review of compliance with the best interest duty and what that looks like. The first real full-scale review, they've done it since the requirement came in 2021. And that was really interesting hearing behind the scenes, I guess, what they've been doing, what they're looking at, what they're considering. And I think, obviously, while Alan Kirkland, the Commissioner, was sort of saying he couldn't give away too much because the report hasn't come out yet, he did give us a timeline of when it will come out and a sneak sort of peek on some of the themes.
Yeah, I thought that was really interesting. We picked it up in our story too, but sort of what they expect to see.
Yeah.
Some of the things he was saying to the room in terms of, you know, he was saying ASIC expect to see mortgage brokers doing their work well, having a consistent and robust sort of process. And, you know, he'll also expect to see it where things are going. When things go wrong, brokers are doing interventions to make sure they go right. So
yeah, and I think that was kind of some of the two main points that I was sort of picking up. The first one about, making sure they have proper responses when someone complains. He kind of was talking quite a bit about that and sort of saying, you know, do you have an internal dispute framework and are you aware of what a complaint actually is? Because it seemed to be that he was kind of suggesting that maybe there have been communications, let's say, with clients that perhaps ASIC would view as a complaint, but the broker perhaps might not have done and just been sort of talking about, you know, let's say an email, going back and forth with the consumer via email and kind of not treating it as a complaint. So that seemed to be quite a bit of focus. He was sort of talking about being like, make sure you are adequately dealing with complaints and labeling complaints and ensure you're kind of, you know, dealing with them early so they don't get further escalated. Yeah,
and he was also warning against sort of relying on standardized responses as well when sort of documenting recommendations and that kind of thing.
Yeah, and I think that's an interesting one, the best interest duty. So when you're recommending a client and a loan to a client and you're talking about why you've recommended that particular loan, he was saying boilerplate is just not good enough. It has to be tailored for every single person with, you know, personalized responses for that client. Because of course, if you're kind of copying and pasting something from, you know, I don't know, a template or from AI, he's like, that's not in the best interest of that specific client. It's not good enough. And I think that's probably got a few eyebrows raised because I think some brokers might actually be doing that, kind of being like, well, are we doing that? And why is he saying that? Like, is that a thing? So I'd be really interested to see what the final report actually found. And he did go into, you know, saying like, really, the report's looking, and the inquiry is looking at some of the largest aggregators and talking to them, seeing what brokers are doing and how they're kind of liaising with clients. The other thing that I took away that I thought was quite interesting, there was a lot of focus on, particularly when loans are the cheapest, and sort of saying, you know, are brokers adequately explaining why they're not recommending a loan if they're not the cheapest loan? And this always comes up, I think, when we talk about best interest duty, is being like, well, rate isn't everything. Yes, you want a competitive loan, But just because someone qualifies for the cheapest loan doesn't mean that they actually necessarily want it, because they might want multiple offsets, for example.
Yeah.
So I think that's the kind of the balance of, well, what does the client want and what is in their best interest? Like, is the report going to say, for example, if a client says, I want multiple offsets, but then you give them a more expensive loan, or not expensive, but a loan with a higher rate because of it, does that mean you're not acting in their best interest by not giving them or recommending the cheapest one? So I think that's really interesting, is that kind of balance of, I'm really curious to see, where does that end up in the final report? Like, will they say, in order to meet best interest, you basically have to convince your client to not have all these bells and whistles because they should have the one that's cheapest.
Yeah, that's interesting. It's interesting too, because he couldn't really give too much away, I suppose, on the day without sort of making that little bit of hinting. But at least we've got a timeline as well for the final report.
So end of this calendar year, the final quarter, he was saying. So hopefully by December, we'll have actually read the full report, know what it says, maybe seen some of the sort of ASIC guidance that comes up around it. I think also, like, he was sort of calling it an information gathering exercise rather than a kind of an inquiry. But I'm just going to read some of his quotes around the rate, particularly. And this is what he said, and I quote, "It means recommending loans that work for your customers' circumstances and priorities, with features that they want or need, at a price that's appropriate given the other offers available on the market. What acting in the customer's best interest emphatically does not mean is simply taking orders when you know a product isn't right for them or where there's a better deal to be had." I think that seems self-explanatory and straightforward enough, but I'm really looking forward to seeing what does that look like from an ASIC perspective.
Yeah.
He was also saying, again, making sure that the documentation was really good, so that you are keeping track of everything that you're saying to clients and why. And the other things that, again, he was sort of touching on were looking at fraud and exercising caution and vigilance when dealing with clients and accepting documentation. Obviously, we know the big mortgage fraud issue that's been going on in the industry with AI documentation. This was I think actually this part was in a question and answer session with CEO Annie Kane when he was talking about this and really saying, it's a serious issue. Everyone needs to be on board, and we need to be kind of taking responsibility from our own unique perspectives, whether brokers or lenders or aggregators or, obviously regulators, being like, there's all of these different things we need to look at. If we're seeing misconduct, reporting it. And that was something that he kind of kept repeating, being like, if you see something suspicious, report it to the adequate bodies, whether that's your aggregator or your ASIC, APRA, AUSTRAC, whoever it may be, just being like, let's try and make sure we're having an impact on stamping out mortgage fraud where it's being found.
Yeah, they're obviously very concerned about it. And I mean, it is very concerning too, but it kind of goes back to one of those things we always talk about on the podcast, that push for the whole of industry response, I think. And that's probably something he's trying to get across to the audience.
Yeah. But I think generally, he seemed pretty much like saying, this is something that's ongoing. We're going to continue to look at it. But for now, let's get the basics right. Let's make sure we're appropriately note-taking and putting forward things that are in the best interest of our clients, and then also protecting ourselves and the industry and our clients from fraud and from risks. So that was a really interesting session. The other big session that I thought was interesting was from the Assistant Treasurer and Financial Services Minister, Daniel Molino, who unfortunately hadn't turned up in person on the day, but he had taken the time to not only do a welcome video to the delegates, but also had a sit down with Annie Kane. I think it was last week, Annie was saying, to record a sort of Q&A. And again, looking at kind of what the government's been up to and what they think of brokers. Ben, what were your thoughts on this?
It was a really interesting conversation to sort of sit through and sort of get their thinking on certain topics that are big for the industry. But yeah, I thought, like, my view was that he really threw the government's sort of support behind the role of brokers, particularly sort of framed the role mortgage brokers are doing within this idea of the government wanting greater productivity and competition within the financial services sector. And he sort of talked about, brokers are now writing 81% of their competition, but they've really strengthened competition within the sector by giving consumers access to more different types of loans, I suppose, which is a very basic one, and it's one everyone in the industry sort of understands, but it's kind of good to hear that coming from the government. as well. He also made some other good points about brokers sort of really providing a crucial role for those segments of borrowers that can sometimes find the lending landscape a bit difficult to navigate.
So first-time buyers,
older borrowers, and that kind of thing. He also sort of touched on, interestingly, he sort of touched on some of the recent regulatory reforms, that including sort of negative gearing, CGT, the ban on borrowing through LRBAs for an for an SMSF. I mean, from my perspective, didn't really sort of say anything that they haven't said before.
I also thought some of the questions that Anya was asking him, he didn't actually answer, but he did a good job of kind of walking around
sidestepping them
exactly,
a little bit.
Yeah, I was a bit like, but yeah, he kind of didn't really make any apologies for what the government had done and been like, again, using this phrasing of wanting to fix the intergenerational inequity or inequality when it comes to wealth and trying to make it, so that first-home buyers and people trying to enter the market have a more even playing field.
Yeah. The other interesting point was when he sort of talked a little bit about AI and sort of the increasing use of that. He sort of acknowledged it was already being used in very productive ways within the industry, but he also said there is a need to sort of make sure regulation adapts to ensure areas such as privacy sort of evolve at the pace of innovation as well. So yeah, as I said, sort of things we've sort of, in some aspects, things we've heard from the government before, but in other aspects, it's kind of good to have him sort of saying these things directly to a broker audience as well.
Yeah, 100%. And I think great to hear, because so often, as you say, like when the government talks about the housing tax changes or the budget changes, they're talking to everybody. So they're it's a broad brush, but to actually have it kind of more nuanced, to being like, well, what exactly do you think this will be doing for brokers? And Annie was kind of really specifically asking that.
Yeah.
And he didn't really talk about it. But he did say, I'll actually read this quote out as well, which I thought was quite interesting. So he said, we felt that, this is on the CGT negative gearing changes. He said, we felt that it was a way of trying to encourage a more balanced approach to the housing market overall between people trying to buy their first home versus investors, while retaining options for investors to negatively gear new builds. And obviously, we also changed the CGT arrangements, returning to the old indexation method. I think a combination of the things the government's doing to provide more access to housing for younger and first home buyers, were kind of helping people into home ownership, but also the rise in services available to them and all buyers to see what options are out there in the market will together be very positive developments. So nothing groundbreaking there, but I think again, kind of defending the government's actions there.
Yeah, absolutely. But yeah, it was really interesting. I wonder what the reception was like in the room, or I guess it's hard to say.
It was actually interesting because I was sat quite near the back, and there were lots of brokers who were actually recording it. So I think they'll probably be rewatching it again today to be like, what do I think about this, and kind of fully absorbing it. But there were lots of people shaking their heads when he was talking about the SMSF resi ban in particular. And he did kind of acknowledge, I think in the video, he said, I know there's been, or something like, there's been debate or some language around that he was saying is probably not quite for everyone, which I think was a bit of a nod to the fact that obviously brokers would not necessarily be the biggest fan of this change. But yeah, he was like, we just want to make sure that super is being used appropriately. And I don't know why this seems to be an inappropriate use, but he's worried about obviously this being a thing, people buying residential property in their super and creating wealth that way through the super fund.
Yeah. But if our listeners are interested in seeing the full interview, we've got it up on our site on the article. So
it's
definitely worth checking out.
Yeah, absolutely. And I think, again, we'd love to know your thoughts. So if you do have any thoughts, leave a comment on the website and on the story. We'd love to check those out and see what you think. And then later in the day, as I sort of mentioned, I did a panel at the conference, which was really interesting. So it's called The Future of Broking, and it had Anya Panic, the MFAA CEO, Wendy Brown from Macquarie Bank, Stephen Bourne from the Lending Association, and interestingly, the CEO of the Broker Association of Canada, and Lauren Vanderberg. And we were kind of looking at, well, what does broking look like now and where are we going in the future, and kind of some of the messaging really along the lines of, we've got 81% market share now. This is, dominant obviously in the market, but the only threat really is going backwards. And so how do you ensure that we don't go backwards, and how do we ensure that brokers are continued to be valued and used by borrowers. And a lot of it was talking about that personalized credit advice and sort of saying, you know, long ago where brokers sort of seen as just brokering a deal and being a sort of introducer. And of course, you know, in the first generation of brokers 30 years ago, many people remember very easy to introduce a client to the bank. It was pretty much name and number and address and off you go. And then over the years, that's kind of built out to be like on much more of the needs analysis and then know your client identification checks and kind of doing a lot more of the admin. And now trying to get a loan done, a huge amount of work involves. It's not just introducing a client anymore. So a lot of the focus was saying, you know, they're really, brokers nowadays are really credit advisors, and credit advisors for the life of a borrower's life, for the length of the borrower's life. So not only from the first time they need a loan, but ongoing. So their first home, their second home, downsizing, car loans, you know, asset finance, commercial, really looking at that sort of whole financial wallet of the client and being like, we're here for every step of the journey, and are so valued potentially by the audience because by a consumer, because of what we do for the whole length of their life and thinking about their kind of future needs. So a lot of really interesting information on that. We actually wrote a story on it on Broker Daily this morning. I could have carried on talking to them for about 2 hours, but I don't think the delegates would have loved that. It was good. And then obviously the awards of the evening was really good fun too. National awards at the MFAA Conference, where the advisor was partnering the Specialty Lender Award, and Pepper Money won that. So it was lovely to see Pepper Money's team all come up and Siobhan Williams talk about what they've been up to. And, you know, I think this award was actually voted for by brokers as well. So I think they were pretty touched that brokers had said they were the top specialty lender for, I think, another year in a row. I can't remember which number it was, but it was something like 7 or 8 or something like that. Yeah, so massive, they've done very well there. But speaking of the lenders, there has been some movement in what the lenders have been doing for brokers, and we'll get into it just after this message. So one of the stories that we were talking about last week, Ben, and in last week's What's Making Headlines podcast was about clawbacks and the FBAA submission to the productivity inquiry, talking about how unfair they thought clawbacks were. And then not too long afterwards, a lender announcing changes to their clawback policy, which again, lots of people were talking about down in Melbourne for the FBAA conference. And this time it was ING saying that they were going to be making a change to basically make clawbacks a little bit more fair, or at least that is the idea, by saying we won't claw back your commission if a property is sold after the 12-month anniversary of settlement. So saying you can have a client who has taken out a loan, let's say they need to move house because of their circumstances having changed, you know, whether that's through death, divorce, or a job loss, and sort of saying, you know, we appreciate that this is outside of the broker's control, so therefore we're making our policy a bit more equitable by removing the clawback after the 12-month mark.
Yeah, so it's between 12 and 18 months.
That's right.
Yeah, so it's that little...
So the clawback period. Yeah.
And I think, you know, as you said, it sort of kind of looks after those circumstances that are completely outside of brokers' control as well. And they've sort of found themselves in a situation where they've done due diligence, made the right recommendations, the broker's sort of gone through the loan process, and then something's happened. And yeah, it kind of feels like in those circumstances, the broker is being penalized, perhaps unfairly.
And I think this is, again, you know, we've been talking about clawbacks for pretty much ever since the advisor started. Clawbacks have been a big topic of conversation, but really interesting to see some movement. And of course, the FBAA came out quite quickly afterwards being like, we love this. It's so great to see lenders do it. Although they did say, we would love to see that change so that it's actually, you know, earlier than 12 months. So that if the property is sold, that's still outside the control of the broker. You know, the broker actually having done that loan, so being like, we would like to see that potentially being 0 months.
And clawbacks are probably one of the most one of the biggest sort of contentious issues, I think, in the industry. So we've had some great responses on our stories as well. There's some comments I'll pull out. Mansoor Sultani, director of Soren Financial, he sort of welcomed the changes, and he said he thinks the current model is broken, the current clawback model, and sort of well overdue for a think. he sort of drew this example in his comment where he said there were sort of 3 clients going through separations in 1 month, which cost his business $17,000
Wow.
in clawbacks.
Yeah.
So that's massive.
And it's so hard for a broker to be able to budget what they actually are going to be earning for not even a year, but for 18 months. Because a lot of the time the clawback period is 18, maybe even 24 months.
Yeah.
I think most of them now are 18 months, but it's sort of saying how hard it is to know what your income is actually going to look like, because you don't know what is going to happen in people's
100%.
lives. And so therefore, 17 grand in 1 month, ouch.
Yeah, Bernard Desmond from Blank Financial, he was another broker who sort of made an interesting point in one of our stories, and he was talking about how he was calling for a sort of a more balanced and consistent approach across the sector. But yeah, he sort of talked about the idea that clawbacks were brought in to sort of discourage poor behavior and not punish brokers who have sort of done the right thing too, which seems to be the area they've sort of floated into. Yeah.
And I think that's totally right. Like, if the lenders are paying a trail commission to basically be like, we want you to have ongoing service, he's sort of like, well, if that's what trail's for, why are we being penalized when there's something happening where it's not our fault and it's not because of our lack of ongoing service or misconduct on our part? It's actually just completely outside of our control. He also made a good point, I think, Bernard, where he was talking about not only clawback being an issue, but also break costs for clients being an issue. If you've got a fixed rate and then something happens beyond your control, you then got to pay quite a hefty fine to come out of that loan. He's like, it's not really a fine, but a cost to get out of that loan. It's like kind of is actually the broker gets clawed back and the client gets the hidden cost as well. It's like, maybe we should just look at how lenders are treating loans that are being exited early for reasons outside of the borrower's control.
Yeah, so it'd be interesting to see if other sort of lenders move in the same direction or what we'll see in the coming months.
Yes, that is the next big question now. Everyone being like, who's next? Who's going to follow?
Yeah.
And of course, like I think, the other thing that ING was doing, it wasn't just the clawback. They also tweaked their commissions. So the upfront, I think they were moving to like a flat upfront model. I think it's 71.5 basis points that they pay. And they were saying it doesn't matter now what the loan to value ratio is, it'll just be flat. And then trail 16.5 basis points, I think, for the life of the loan. So some brokers being like, actually, that's less.
Yes.
So not loving that.
Yeah.
But then they will also increase how large a loan a broker can earn commission on. So it used to be a $2 million limit, now it's a $5 million limit. So again, brokers will be pretty chuffed for that. So generally, I think they're pretty happy with ING. I wonder if it will end up, though, in resulting in more brokers using them because of these changes.
Yeah, that's a good question. Yeah.
And I think, again, just noting the FAA's comments here, again, talking from Leo Gadzik, who's the CEO, who's been talking about this last week. He was saying, it's taking an important step in the right direction, and really kind of saying if other lenders do what ING has done, it's a positive start. So putting out the call to action there for the other lenders to come and meet them at the table.
Well, that was another broker comment I wanted to call out. I think Kit Johnson from Aussie Forest Lake sort of described it as a really encouraging sort of step and a step in the right direction. But he sort of said of the loans he'd written recently, it wouldn't really apply to many. So,
yeah. And I think that's it. It's again, while brokers are like, yes, this is good, but they're like, well, actually, most people probably that have the largest clawbacks are refinancing or exiting their loans before that 12-month mark. So we'll keep you posted on how that goes. But I mean, we've talked about this so often, and we know brokers have been working on wanting change for so long. You might recall earlier this year, we heard from Treasurer Jim Chalmers, who responded to a petition that a broker started in WA calling for clawbacks to be cancelled. And he basically was saying, no, we're not going to intervene on this.
Yeah.
He's saying it raises complexities. And he was basically saying the government shouldn't really be interfering in kind of, business decisions, and saying broker commissions are ultimately a commercial matter for negotiation between brokers and lenders, and subject to the existing regulatory framework. The government does not prescribe situations in which such arrangements should be entered into. The clawback arrangements entered with each credit provider may vary and have adapted over time, driven by market competition pressures and a desire by lenders to attract referrals from brokers. Removing clawbacks could lead to adjustments in overall commission structures, potentially reducing the upfront or trailing commissions brokers receive or increasing costs for consumers. Similarly, retrospective refunds would require altering commercial arrangements and introduce uncertainty for lenders and brokers. So government sounds like they ain't going to do anything.
No, definitely not from those comments.
Pretty strongly worded and clear enough there from Treasurer Jim Chalmers from that letter in February. And again, that's in the story. If you want to check it out, the ING story is running on the Advisor. You'll be able to find the link to that if you missed it in February. When we come back from the break, talking about some of the other interesting news we had this week, a new report looking at which aggregators are moving and growing, which ones are attracting brokers, who they're attracting, where they're attracting brokers from as well. And we'll get into that just after this message. So here's a fascinating piece of research that came out this week, and we were really thrilled to have been given the exclusive access to it when it launched. And WealthX, which is a fintech platform that provides mortgage brokers, financial planners and accountants with data insights to kind of help work with customers in a better way or in a more informed way, released a new report which looks at ASIC data sets, so looking at the credit representatives and credit licensee data sets, and trying to figure out, well, how many credit reps do each aggregator have? So this is really interesting. This is the inaugural Mortgage Broker Movements Report, which was prepared by WealthX in partnership with Padua Wealth Data. Now, Padua already do this for the financial planning sector. So Clint Howen, who is the founder and CEO of WealthX, asked Padua, can you do the same for brokers? And he was like, sure, why not? So this report came about, and it basically tracks the movement of credit representatives between Australia's 10 largest aggregators, so including sub-aggregator brands, as per the ASIC credit license and credit representatives data sets. Now, we've had many questions from the aggregators about how this information is arrived at and how they're kind of tracking the licenses, because there seem to be loads of brokers missing.
Yes.
So it's a bit like, well, what's happening here? So I'll give you an example of that. So this report covers the second quarter, the June quarter, basically. And they looked at ASIC data. They looked at the number of credit representatives listed under the licensee head group, i.e. the aggregator. And this doesn't include credit licensees, so ACL holders, doesn't include them. It's just credit reps. And it basically found that across the 10 largest aggregators, there had been 959 credit reps leaving groups and 853 credit reps joining groups. So a net contraction of 106 brokers. I thought that was pretty interesting, firstly. But also, it only found that there were 17,748 representatives operating under these 10 largest aggregation groups. And I thought that was a bit small.
Yeah, it seems a little bit.
Because surely, I think, like, you know, we've hear from different associations that trying to estimate the number of brokers. And I think at the moment it's sort of between 22,000, 23,000, something like that. And I was like, surely there aren't 5,000 brokers who have their own ACL. I thought it'd be way smaller than that.
Yeah, you'd think so. That seems a little bit
askew. But lots of aggregators reached out to us to be like, how are they tracking this? Because these numbers don't obviously reflect our numbers. And we know every time we do a story for like results reporting season, for example, or end of financial year, we normally get the broker numbers from the aggregators, and they're much higher than seem to be listed under this ASIC credit representative data set, at least. So I wonder if the ASIC data is wrong, or if perhaps people aren't being categorized correctly, because there seem to be people missing. But based on this information and based on this report, really interesting to see which aggregators are growing. Was there anything in there, Ben, that kind of stood out to you about some of the big moves and changes?
The one that stood out was the highest net growth of the top 10, which was Specialist Finance Group, which sort of over the quarter in question grew 3.11%. That was interesting.
That's massive,
too. I guess, you know, we saw the largest decline from Finsure over that period, with 234 brokers leaving that group, which you could probably link with what's happened with the sub-aggregation agreement with High Money, which impacted around 211 brokers during the period. But yeah, it was just super interesting to sort of see the movement, particularly when you sort of break it down between states as well. Another interesting thing that sort of popped out was from the data was, for example, despite being headquartered in WA, Australian Finance Group had more representatives in Victoria than any other state. Like little wrinkles like that were really interesting, I found.
And I think even in that data, when I was looking at it, it said that AFG had something like 370 something brokers in WA who were credit reps based in WA. And I was like, that cannot be right.
Yes.
That's way too small.
Yeah.
Maybe there are. But I was like, surely an aggregator the size of AFG, it's a massive aggregator. I'm like, surely it would have more than that. Because they were headquartered there.
I think as more time passes and they sort of start to release new sort of versions of this report for subsequent periods, it'll be really interesting to start tracking the movement between aggregators as much as you can and that kind of thing. I guess this is only the first one, so we're just getting the first glimpse of the data.
Yes, I think there is a tiny section in the report itself which looks at which were direct movements. So if you can see a credit rep moving from one to another aggregator, they could see that.
Yeah.
But it was probably, maybe 4 sentences of the whole report. It wasn't a massive focus. But I did think, not only looking at SFG growing a lot, which was, really big, I did also think Purple Circle had grown quite a lot as well. And I actually had a chat with Purple Circle down in Melbourne this week to be like, is this, like, what did you think of the data? Does it reflect what you're seeing? And they were like, we've had way more people join us than that. So again, sort of looking at where's this credit rep data from ASIC coming from and how are they categorizing it? Because they were like, we have more. But they've had a bumper year. So that was really interesting seeing the different growths and movements. I did also think looking at who's losing the fewest brokers according to this analysis, it was Mortgage Choice.
Yeah.
So over that June quarter, they lost 28 brokers. And according to the data, means that they have 838 credit reps under their license. Don't think that's, again, not sure where that number is coming from, but really interesting to see. And I'm sure all the aggregators now will be looking very thoroughly at the ASIC data sets themselves to be like, is this correct for the next iteration?
Yeah, and I guess one of the things you're always sort of drawn to with a data set like this is sort of who's the biggest, who's the smallest, and that kind of thing. But they did sort of mention when they put the data out that it's, bigger doesn't necessarily mean better in the aggregation space as well. And brokers choose aggregators for a range of reasons, including the support culture and technology. It is interesting to sort of see the size of everybody, but that just tells part of the story.
Part of the story. And I think, again, like as we say, this is just for credit rep data. It's not for credit license data, ACL holders. But when I was talking to Clint for it, I was like, well, why do this? Like, it's not your core business area. You're not trying to get people to join certain aggregators. He doesn't have a vested interest. And he's like, I just think it's interesting. He was like, I have seen it in financial planning. I thought we could do one with mortgage broking that's a neutral party, an independent party that doesn't have a vested interest. You can see this is an impartial data source we're using.
Yep.
If the numbers do lie, then maybe we should be fixing that as well. But he's a bit like, really, I think it's good to be transparent, to have a healthy industry and to be able to be sure we can kind of be aggregator agnostic and see something that is neutral and kind of make our own decisions. So basically being, I just want to help brokers make better decisions. That's what WealthX is for. We do this with data. So it just felt like a report that we could put out and provide some value back, which I thought was really interesting.
Yeah.
If you haven't read that report and story, it's from, I think, came out on Monday. So you can check that out on The Advisor. And I would definitely recommend it because it is really interesting. And if you've got any questions about it, then please ask them.
Yes, that's it. Yeah.
Lots of people are calling us, asking us questions about the data. And I'm like, it's in the report. You can read it in the report. We didn't write it. So really interesting. And I think that's probably the 3 main big stories we've been writing about this week is sort of the commentary coming out of the MFAA conference, the broker movements report, and the clawback changes.
Yeah, but 3 massive stories for our readers as well.
Yeah, huge. And there's obviously a lot more news out there from this week as well that I would encourage you to go and check out, including what's happening with property prices, what's happening with the lenders. And you can find that all on theadvisor.com.au. And if you've got any stories or news for us, then do feel free to reach out. You can reach us at The Advisor. I'm editor at theadvisor.com.au. And of course, leave a comment on the stories. Let us know what you think about them. And if you've got any gossip for us, let us know. We'd love to hear it. Ben, any nice weekend plans?
Not too much locked in at the moment, but hopefully that'll change. Fingers crossed.
Yeah.
But yeah, just to relax mostly.
Me too. I just need to catch up on some sleep. That's been a massive week, and I feel absolutely discombobulated. Don't know what day or time or where I am. I'm like, what's happening? I thought today was Friday, so I was a bit confused about that too.
Yes.
Wait, I actually won't say that because it is Friday when this comes out.
Yes. Yeah.
Don't know what day it is, but hopefully after a restful weekend, we'll be back on track, and we'll be catching you next time for an episode on the Advice Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.